We're so glad to have you this afternoon or evening, depending on where you're joining us throughout the country today, California, New York. My name is Samara Blackman, and I'm the new financial wellness counselor in the Western region for the Actors Fund. I'm actually new in my position with the Actors Fund, so I'm very excited to be here with you today. Also, for those of you who this is your first event with the Actors Fund, with our financial wellness program, I want to take just a couple of minutes before we get started to give you some information about the Actors Fund and the financial wellness program. So first, the Actors Fund is a national nonprofit that provides free programs and services for performing arts and entertainment industry professionals, offering just a wide range of services that can support you in a variety of areas, whether it's from social services to the Career Center to the financial wellness program. So for more information about what we do offer and what might be helpful and available for you, I'd recommend going to our website at actorsfund.org. That's www.actorsfund.org. Today's workshop, it's tax time. Isn't that exciting? It falls under our financial wellness program, which is the program that I am working with. If you're interested in learning more about financial wellness, please also check out our website, the Actors Fund website, or join us the first Thursday of any month for Budgeting Nuts and Bolts, which I had earlier today. So a hello to those that I met at the workshop earlier today, and thank you for being here. But Budgeting Nuts and Bolts is a 2-hour workshop. It's the starting point for participating in the financial wellness program and how you would get started with us here in the financial wellness program at the Actors Fund. From there, from that first class, you can, from that first workshop, you can take a class and join us for a 6-week class along your financial wellness journey. But overall, the goal of our program is to engage, educate, and empower performing artists and entertainment professionals about the role of money in our lives. I think, and you'll see that financial stability and art can actually go hand in hand more seamlessly and more beautifully than many of us think. And so that really is the goal of our program. So with that, thank you for being here today. Thank you for joining us. Definitely looking forward to this conversation. And I'm now going to introduce or hand this over to Tina Hookham, the Director of Social Services for the Western region at the Actors Fund. Her and I will be co-facilitating today. So welcome, Tina.
Great, thank you, Samara. Welcome, everybody. So to get started, let me explain how we will work today. We have 2 panelists, Robert Chang from the IRS Tax Advocates Office and Ronnie Steadman, who's an enrolled agent with the IRS. As Samara said, she and I will be co-facilitating our conversation. We also have Ashley Burrows with us. Ashley is a CTAC certified and bonded tax preparer that works at Entertaining Taxes. She also works as a professional actor herself and really understands the uniqueness, right, of the entertainment industry and expenses. Ashley is also one of our site coordinators and a volunteer at our VITA program at the Actors Fund, so you may recognize her name. So Ashley will provide support by answering questions that come in through the Q&A feature on this webinar. So for some of us who may not know, at the bottom of your Zoom screen toolbar, you should see the Q&A button at the bottom. If you have a question, go ahead and type that in. That question is going to go directly to Ashley and only Ashley. The group will not be seeing your private questions sent to her. She's going to do her best to answer questions and provide links and resources as well. However, we do want to be clear that she and none of our panelists today will have the ability to answer specific professional tax questions related to your specific situation. We're also going to have the chat feature live, which I see some of you already using. That's great. We're going to be using the chat feature to provide links and resources only. So it's unlikely that we're going to have the time to answer the questions that come in through chat. So if you have a question, please use the Q&A button. But please, if you can, go ahead and open up that chat screen so you're going to begin to see a bunch of resources that we're going to put sourcing through the chat box. We've received all of your questions that you have sent in when you registered. Thank you. They are wonderful questions, and we'll be using those questions to frame much of our conversation today. We have about 90 minutes for our workshop. We will be recording our session today, so please be aware of that related to anything you enter into chat. Participants are not seen by the viewers in this webinar format. Okay, so let's get going. Let me introduce our first panelist, Robert Chang. He has worked with the IRS for 15 years in various roles. He currently is the acting local taxpayer advocate with the IRS Advocate Service in San Jose and Los Angeles. The Tax Advocate Service is a national program that helps ensure that you're treated fairly and you understand your rights with taxes. So advocates help you if you have a problem that you can't resolve on your own. So our first resource is going into the chat. It's the Taxpayer Advocates website. If this resonates for you or you have more questions, we hope that you use that resource and get some support. But welcome, Robert. I'm going to pass it off to you and have you take us through your presentation.
Thank you, Tina, and thank you, Samara, and thank you for the Actors Fund to have me today to share what our office could provide to the public, and definitely thank you for this opportunity. So first of all, let me share my screen so we have some visuals. Can you just 1 second? Okay, great. Okay. So for the next 15 minutes, what I have planned for today is I will be briefly covering the background of the Taxpayer Advocate Service, who we are, what we do, where we are located, how do you need to contact our office. And then I do have specific questions received ahead of time, so I'll be covering the remaining of my presentation, focusing on the payment options in the event where if an individual taxpayer couldn't make the full payments, what are the options? So without further ado, there are certain required marketing messages that I needed to share. Okay, so who we are, Taxpayer Advocate Service is an independent organization within the IRS and was created by the IRS Restructuring and Reform Act of 1998. And this act does strengthen the Taxpayer Advocate organization by making it independent within the IRS, meaning that for IRS, they do have audits, they do have collections, they do have customer service, but our office is separated, under the IRS umbrella, but separated from the remaining IRS functions, if that makes sense. Okay. Our statutory mission, under the Section 7803 of the Internal Revenue Code, the Office of Taxpayer Advocate has two principal statutory missions. And here on the screen, we have 4, but you can really be consolidated into 2. The number 1 is to assist taxpayers in resolving problems with the IRS, which we do have a function called case advocacy. That's where my office is under. And to identify areas in which groups of taxpayers are experiencing problems with the Internal Revenue Service. To the extent possible, it is also required to propose administrative or legislative changes to resolve or mitigate those problems. And that's where we do have another function with subject matter experts who are behind the scene, try to look at the various problems happening in the field and to see if there are opportunities that we can be proactive and stop or make some changes to make the tax ecosystem a better place. So, okay. Next slide. This is a visual in terms of our office locations nationwide, and by statute, TAS is required to maintain at least 1 local taxpayer advocate office in each state. So nationwide, we have approximately over 80 plus locations, and of course, 1 or more in the larger state, and 1 in District of Columbia, and 1 in Puerto Rico. And specifically in California, we definitely have more than 1 offices. This is a quick snapshot of the local offices in California. However, in the state of New York or in the state of Chicago, there are also multiple local offices. And where I'm located, I'm with the Los Angeles office. So each office does have its own intake line and the fax number. So in the event where you're needing services, you can contact each local office, or you can call our national 800 number, toll-free number, or you can go to the IRS.gov and search the keyword local taxpayer advocate, and it will list all the locations where that's the nearest location near you, if that makes sense. Form 911. This is the visual of the form that will be helpful when you first communicate your tax issues with our office. It's a very generic form where it captures your basic information, your name, your social security number, your address, the tax form that where you have issues, the tax year. How could we contact you by phone or by other means? So this is the top half of the form 911. Once you complete that, this is the bottom half of the first page where I have the red highlight markers around line 12. That is very important to our office because it really help our staff to set up a case by knowing what type of tax issues that you are experiencing. And in 12B, it asks for what kind of relief or assistance you are requesting. So by knowing that, then it gives us a little bit more clarity and transparencies to further review your inquiries. And some of the inquiries might not result in a case. It might just be a simple inquiry or a simple phone call that we can take care of that. But if for more complex issues, by having fill out this form and fax to our local number, that will be very, very helpful. And if you didn't have a chance to jot down the numbers, here it is again, or you can go to the IRS.gov and type in the keyword local taxpayer advocate, and the local intake line or the fax number will be available online. Okay. So this slide covers a little bit about our case acceptance criteria. So our criteria is being separated into two main categories: economic hardship or versus the systemic hardship. So if we look at the economic hardship, we have suffering economic harm, facing adverse action, will incur significant costs, or will suffer irreparable injuries. So let me give you an example as to what does it mean by economic harm. So for example, a taxpayer came to Taxpayer Advocate with an eviction notice stating that he will be evicted if his rent is not paid. The taxpayer is awaiting a refund of $2,000. This refund will pay in full his arrearage, thus preventing the eviction. So that is one of the typical examples that we see that taxpayer does come to us when they are facing adverse actions. In terms of systemic case acceptance criteria, we have significant delay for more than 30 days, no response resolution by date promised, systemic or procedure failure, best interest of the taxpayer, or public policy determined by our leaders. So, so we have the most of the typical taxpayers that who come to us is because they are, let's say for example, they are in a certain process with the IRS and suddenly they couldn't reach anybody, or the IRS have never chose to respond to the letter that they sent in. So if there's a significant delay, more than 30 days, but nowadays, I think that number might become higher. But it is a protocol to ensure that the taxpayer has the information that they need in order to proceed with their tax controversy issue with the IRS. And please keep in mind that our office, are comparatively with IRS are a smaller function. So if you we do encourage taxpayers to at least to make the first attempt to reach out to the IRS. And for most of the inquiries, those can be resolved quickly. But for those inquiries that still are lingering or you are hitting a brick wall, then please reach out to our office, and then we can see what's going on with your matter and provide the appropriate advice there. For slide 9 to slide 13, this portion of the presentation will be covering the specific questions that I have been receiving from the Acquisition Fund staff. The key question is, if people don't have the ability to pay all or to full pay, what should they do? What if I start a payment plan and I'm not able to pay? I had a payment plan. I thought I could pay, but I can't. How to negotiate payment plan with the IRS when I cannot meet the payment timetable? So those are, I can see a lot of the sub parts of surrounding the payment options. So when you don't have the ability to full pay, what should the taxpayer do? So here are the couple options. Definitely enter into a payment plan with the IRS, but please be sure, please don't enter a payment plan where you cannot afford, or else that would be sitting, that would be doing you a disfavor. If you are in the payment plan and you couldn't pay, there are a mechanism where you can temporarily delay the payment by calling the IRS. The IRS will be collecting some financial information from you, and if they determine that you cannot pay any of your tax debt or part of your tax debt, the IRS may put you in something like the terminology that they use is currently not collectible, or temporarily delay the payments until your financial condition improves. And having that said, this does not delay the interest from accruing from your account. This is more of a temporary band-aid to help you to delay the payments. And depending on the outstanding amount, the IRS might be asking you for a more detailed financial information, which they use the form 433. And there are a lot of variety of, in terms of 433. So this you might, need to consult with an in-tax professional to help you to navigate this. Okay, and the last option is something called the offer and compromise, which I do have a specific slide for that item. So I will be touching that very shortly. But before we proceed into the offer and compromise, I did prepare a couple slides to demonstrate if, let's say, you are in need of a payment plan, what would it look like via the IRS.gov operation? Where do you have to click in order to reach the page that you needed to reach? So so you can access the IRS.gov through your phone, your computer, your tablet, and this is what you will be seeing on the left-hand side, the main entry page. And if you can see, I highlighted, make a payment or pay. You can click either of those two spots, and then that will bring you to the next page. And towards the right-hand side of the screen, you can see there is a little section discussing can't pay now. And there's a payment plan link. There's an offer and compromise link, and there's a temporary delay collection link. Depending on your situation, you can click those links respectively. And then on the left-hand side, there's also a payment plan link. So there's definitely more than one way to access the installment agreement option here. So after you click the payment plan, that will bring you to apply online for a payment plan. And this is where you can follow the instructions and read to see if you qualify based on the outstanding balances and what do you need to do to apply for a payment plan and if there's any cost associated with it. And then if you already have a payment plan, how do you revise the existing plan? And towards the right-hand side of the screen, that's where it kind of describes the temporary delay, the collection process, what you needed to do. And with the telephone number on the bottom, the number that you should call to make such a request, if that fits your situation, your needs there. Okay. So here is the offer and compromise landing page. And basically, what is an offer and compromise? This is something that allows the taxpayer to settle your tax debt for less than the full amount you owe. So let's say if you owe $50,000 and really you lost your jobs and you don't have any assets, and what you could really pay to the IRS is $50. And of course, there are much more in depth of the eligibility to this program. But let's say $50 is all you can offer to the IRS in exchange for a total offset with your current tax liability. That is possible through this program. But I think the key is there are very specific rules and regulations as to who qualifies for this program, who does not qualify for this program. The IRS consider each taxpayer's unique set of facts and circumstances based on ability to pay, income, expenses, and asset equity. The IRS generally approves an offer and compromise when the amount offered represents the most the IRS can expect to collect within a reasonable period of time. So let's say if you temporarily lost your job, but you still have the opportunity to regain, into the job market. So that will be one of the considerations the IRS will definitely be looking for. But please explore all other payment options before submitting an offer and compromise, as this is the last resort. And again, this is not for everyone based on the eligibility requirements. Please do consult with a tax professional if possible. And of course, one of the questions that I received is, well, I'm already in the very disadvantaged situation, and I don't have the resources to consult with any tax professionals. What do I do? So under tax, we do have a separate program called the Low Income Taxpayer Clinic. And in each clinic, they do have tax professional staff in-house where that they can represent eligible taxpayer based on income before the IRS or in court, tax court, on audits, appeals, tax collection matters, and other tax dispute, including the OIC, offer and compromise. Services are provided for free or for a nominal fee. And I would say, if you are serious considering offering compromise as the only option for you to offset or to settle your debt, having that privileged conversation with tax attorneys to go through all of your options, I would say that would be the best course for you. There are a lot of the rules and regulations which sometimes might pose another layer of challenges on your end. So if you have that navigate consultation resource or having a representative resources from one of those low-income taxpayer clinics, that will be, I believe that will be very helpful to you to not only gain the holistic picture as to what you are facing, the status quo and what are the remedies, but how you can receive the substantive assistance. On the screen, I listed out the clinics that's in the Southern California, but LITC, this program does have 130 plus clinics nationwide. So if you are interested to find the the clinics nearest you, you can go to the link on the bottom of the screen, or you can reference the IRS publication 4134, which will list all the clinics nationwide. So this is all I have prepared for today, and I'm going to return the mic back to Tina or Samantha to see if there's any questions or how I should proceed from here. Thank you.
Great. Thank you so much, Robert. Thank you. Thank you. So we're hoping that there were some takeaways that everybody was able to hear. So if you have more questions, I hope you could, just some tips for this webinar. We're going to be going through a lot of resources. So you might want to consider opening up a Word document so that you can cut and paste things that are being posted in the chat into a Word document. Also, you could take a picture of certain slides, and we will have all the information that is being shared today at the Actors Fund. So thank you so much, Robert. We really appreciate your time with us, and thanks for being with us.
Thank you.
Okay. There's some questions, and I just wanted to, before we introduce Ronnie Steadman. So our intention today is to cover the next things coming up. We will be covering is sort of unemployment benefits, pandemic relief, stimulus package. How does that relate to our taxes? We're going to be covering LLC and S Corp. We're going to be covering business deductions, and mostly how to file online and free resources to be able to do your taxes during this time of COVID-19. So those are the things that are to come. I have heard from Ashley. I know people are asking questions. Continue to do so. And thank you so much for some of our folks in the audience today that have also posted some really great resources. So we're going to move right along. Help me welcome Ronnie Steadman, who's our next panelist. Ronnie is an enrolled agent with the IRS. He's bringing over a decade of experience in handling both personal and corporate tax returns. Ronnie is also an actor and had a fruitful career in independent films and national commercials, television, and stage. He understands the unique stressors that creative professionals have related to taxes. He works with Steadman Tax Services, which is an affiliation with Chuck Sloan and Associates, and he's been there for 14 years. So welcome, Ronnie. If you can turn on your camera now, we're gonna jump right in.
Hi, everybody. How are you doing?
Great. So many of our questions that the group asked was about unemployment and specifically pandemic benefits that we received. And I'm wondering if you could just, kick us off with, do we owe taxes on unemployment, and specifically the stimulus and pandemic benefits we received?
Yeah, you do. Unfortunately, there had been talk of it, them exempting those from taxes, but unfortunately, you do have to pay taxes on it. You don't, if you live in California, then California does not tax the unemployment, but the IRS does tax.
Okay, great.
And I've seen the impact of that already this year, because I don't know if this is, I know California mostly, they have not been, even if you check the box to have them withhold, they only withheld from your base rate, not from, they didn't withhold from the add-on. And so that's causing a lot of consternation, because people are owing money this year a lot of times because of the unemployment.
Okay, wonderful. And is that, so that includes that $1,200 stimulus check that we might have gotten at the beginning of pandemic, as well as the $600
No,
add-on?
That is not taxable. It is only the add-on for unemployment that is taxable. So now what's great about this, the stimulus check is not taxable. If you didn't get the stimulus check, then make sure your tax preparer knows that, because then it could become, or if you're doing your own taxes, most of those programs are going to ask you this question, but just if you didn't get it, then it should be a refund on this year's, as long as you qualify. If your income is too high, then you won't be able to get it. But if your income's at a low, if it's under whatever those, it's like 75 for single, 150 for married, then you'll get it as a refund or a credit on this year.
Okay, great. So that was one of our specific questions, and making sure everybody heard it. If you didn't get the stimulus, there is a possibility that it could be a credit on your taxes for 2020, correct?
Yeah, correct.
Okay, perfect. And just tell us about that 1099-G form, right? That's what we should be receiving in the mail?
Yeah, you should get that in the mail. And if you if you don't get it and you have taken unemployment, you should be able to get it on what, like in California, it's the EDT. I'm not sure what it is in New York or other places, but you should be able to get that online.
Great. So
And,
we need
it's gonna, it's going, yeah, you need it because it's going to show how much you, it's going to show how much you got from unemployment and how much you had withheld throughout the year.
perfect. And just to clarify, it sounds like what you're saying is that even if I had taxes taken out in my weekly amount, I would still
Yeah.
receive the 1099-G, because chances are if I received the add-on, I would still be owing something attributed to that add-on.
Right. And it works just like a W-2. I mean, the withholdings are just withholdings that go into your overall bucket of withholdings. So you would always need that form anyway, because even if you've paid your taxes on it, maybe you paid too much and you'll get some back. So it just all goes into your big bucket of withholdings, you know, and then when you're doing your tax return, you're figuring what your tax is, and then you're hoping that you had enough withheld so that you refund it. If you don't have enough withheld, then you're going to owe something.
Okay, great. Can you tell us about the pandemic recovery rebate?
Yeah, so that's what I was talking about earlier. If you didn't get the stimulus check, then the recovery rebate is because you didn't get the stimulus check, now you're getting a rebate on it. And what's interesting is, and this may apply to some of you, is that if you had, say, a kid in 2020, then even if you got the stimulus, you wouldn't have gotten the portion of it that was for your kid. So you'd get the extra $500 for the first one and the extra $600 for the second one. So that could mean $1,100 for you. And if you had twins, that could be $2,200 for you. This would be great.
That would be
they
great.
pay for themselves, the kids, you know.
And we had a question I think might relate to some of us here. So if I am receiving unemployment in one state, like New York, and I live in another, how can I get the state taxes back that you've paid on unemployment?
By filing in the state that you'll always have to, if you're living in California and have New York unemployment, you'll have to file a New York return because New York does tax the unemployment. If it's so they'll pull out New York. Usually they'll pull out withholdings for New York. But even if they don't, you're gonna have to file New York to make sure you don't owe New York at that point. With California, California doesn't tax the unemployment, so you don't have to worry about that. So if you're taking California unemployment and you're in New York, then I honestly don't. I think New York might actually tax the unemployment that you get because you'd be a resident of New York. So I'm not sure about that one, but I think that would probably be true.
Okay, great. And then we had a couple of questions about deductions related to unemployment. So I'm not sure if this is going to also blur into our conversation about business expenses. So you let us know if we should carry this over. But someone was asking, are there any benefits to itemizing deductions if the total is less than the standardized deduction? So I don't know if you want to explain standardized deduction first, whatever you'd like.
Sure. So the unemployment is irrelevant when it comes to deductions because there isn't a way to take deductions against unemployment. But first of all, the standard deduction is just it's the standard deduction that everyone gets no matter what. For a single person, it's I can't remember the exact number. It's over $12,000. For married, it's over 24. For head of household, it's over 18. And it always goes up just slightly every year. That means no matter what you do, you're getting that deduction before you get to your taxable income. So if you made $100,000 and you're single, your taxable income would be, if it was just simple and you got one W-2, your taxable income is going to be $88,000 or a little under $88,000, and then the tax table is going to relate to that. With the 2018 Tax Cuts and Jobs Act, so this relates to do you bother to take deductions if you have anything under 12,000? That wiped away all W-2 deductions. So you don't get any W-2 deductions when so if all your money came through W-2, then your deductions really you're going to count for nothing on the federal side of things. But in California on the state side, and I believe in New York on the state side, and I can't remember, I'm not familiar with some of the other places like Georgia or like Illinois, you do still get those deductions. So it is worth putting it together, because you might get, because California's standard deduction is under $5,000 for a single person. So if you have $10,000 worth of deductions, you're not going to get any benefit on the federal, but you will get some benefit in California. Now, on the other hand, if your income is coming via 1099 or just cash income, you know, so you do a non-union, like a print job or something like that, or you do, you know, like a lot of theater might be non-union, that kind of thing. Although who's doing theater these days? But if you're any of that kind of income, then you can take deductions directly against that income as the deductions apply to that income. So, you know, you can't take your W-2. So if you have like, you know, $50,000 in W-2 and you have $10,000 in agent manager fees, you can't take that over on the 1099 where you made $1,000. But if you made $10,000, if you made $100,000 on 1099 and you have $20,000 in agent fees, you can take it all there. So you don't lose anything in terms of deductions against 1099 business deductions.
Okay, great. That's a lot to take in. So I hope
Yeah,
everybody's
sorry.
following that out there. There's a lot, and we're going to put some resources in the chat, but hope everyone's kind of following along the best that we can. But thank you for all of the details.
You got it.
There was a specific question people had. I'm just going to take a moment. A couple people asked if I received financial assistance from the Actors Fund during COVID in our emergency response. Is that, should that be concerned as earned income, or would you receive a 1099, I guess? And we just want everybody to know that financial assistance grants that were distributed from the Actors Fund or any relief organization are considered non-taxable grants, gifts. And the IRS doesn't require us to issue a 1099. So just if anybody's out there and did receive a financial assistance grant, you will not receive a 1099 from the Actors Fund. We're going to switch hats now. We're going to move into sort of our business questions and ask questions about LLC or S Corp, that conversation that just keeps coming. So
Yeah.
Ronnie, start us off by just helping us understand the difference, right? The difference between the LLC and the S Corp, and then we'll start going into more specific questions.
Okay, so and both LLC and S corps are to understand that they're considered individual entities. In other words, they're separate from you. They are like persons to themselves. However, an LLC is, you know, it stands for limited liability company. It is not a corporation. It is exactly what it says, a limited liability company. So its treatment by the IRS is considered disregarded for tax purposes. So if you have an LLC, you're not getting any tax advantage at all from having it. You may need it for legal reasons. So most of the time, productions, you know, you'll, some people put together a production and they need legal liability, you know, a legal liability shield. So they'll create an LLC. But that has zero tax advantage. Also, LLCs can be formed as partnerships. So that's often what films are as well. And those require a different type. So with an LLC, you just file it with your personal tax return. So some states like California, you have to file a specific LLC return on top of your personal return, but it's connected to your personal return. If, however, you have a partnership, then you have to file a 1065, which is more of a corporate level return. Still not a corporation. Now, corporation is a corporation, so it's like essentially the difference between them is that they're just different style of structures. And now, what's confusing about the whole thing, though, is the idea of an S corporation, because an S corporation, is just a tax designation that you add to either a corporation or an LLC. So using the term S corporation, it means you've made an election with the IRS to be treated as an S corporation because it's a specific tax designation. Now, with an S corporation, you do have certain tax advantages. An S corporation, though, does cost you in fees typically more to run. So be careful. Don't run out and get an S corporation just because you've heard, it's the way to go, and you're gonna get some tax advantages. So make sure you get advice from a tax professional, someone who knows how to deal with it, because you are going to run into you'll run into fees with both an LLC and a corporation or an S corporation, but more with the S corporation. And the reason is that you become an employee of that entity. And so you have to run payroll. You have to do a corporate level return, which with my business, it costs 3 times what an LLC like add-on return to a personal return does. So, and then you also would need to do, you probably want to do bookkeeping with that. So it gets a little more pricey, quite a bit more pricey, I should say, than just an LLC.
Can you just give us a rough idea for some of us out there, like how much would it cost to create an S corp, and how much would it cost just to get going, just to start it up, do you think?
Well, it all depends on who you're, like, if you just go do it yourself on like LegalZoom, then I think it'll cost maybe, well, I couldn't tell you for sure. It kind of depends on what you pick there. So like they'll advertise it for like $199 or something like that. But then when you get in there, they're like, well, if you want us to file the S election, it's $60. If you want us to file for the EIN number, it's another $60. If you want us to be your registered agent. So there's all these attachments to like filing that way. And if you do file with like a LegalZoom, then still go and talk to a tax preparer or someone who understands how to deal with corporations. Because that doesn't put you in a position where you're getting like payroll and things like that done. So you have to make sure you do all of those steps, because that could bite you later down the road. Because if you're not running payroll under corporation, then you're doing something that's illegal, because the law says you have to do that. So you might be saving on taxes, but you should be looking over your shoulder, because somebody may come for you one day and it won't be fun at that point.
Great. And help us understand a little bit, Ronnie, just in that, related to that payroll, that relates to our safety net, right? So if we're not running the payroll outside of it being illegal, also the factor for us is, people that have sporadic income and are working in the industry, we're not going to have unemployment to collect, right? Or that's not going into our Social Security. We're not paying towards state disability, right? If we're not running that payroll. Is that true? Is that accurate?
Yeah, absolutely. That's true.
Okay, so it's a really important factor. I'm hoping everybody's paying attention, because that can be an unintended consequence, right? That you're not realizing that all comes together in a time of need, when you've been used to filing unemployment and suddenly you've created your corporation and you haven't done payroll. There's no unemployment there as your safety net. So just want to highlight that. Help us understand, like, when in my career, right, would I start to think about making this step towards incorporation? What, financially, where should I be consistently? Help me understand when to start considering that.
Well, it would all depend on what kind of fee structure you end up with, because what you're trying to do is you're trying to beat with the tax savings, of course, how much it's costing you in fees. So if you so I would say, like, depending on who you're talking to, because different outfits are going to have different fee structures, but I would say you can probably get it done if you're doing everything the right way. It's probably going to cost you at least about $3,000 a year to run a corporation. So if that's true, then you need to have at least $3,000 in tax savings. So if you're making, say, 70 grand a year, and you have an agent and manager, that's at least $14,000 in deductions. So and you're in a 22% bracket. So 14 times 22% is a little is what is that? 28, about a little over $3,000. So you're kind of in break-even mode right there. And then anything else that you might add as expenses is gravy at that point. So you're doing good. So I'd say you probably want to be consistently in that range of making about 70 grand a year before you. And now that being said, if you book a straight to series type scenario, and this is probably something you're going to hear from your agent and everybody at this point, so it's not going to be, but maybe you heard it here first. I don't know. You will want to get a corporation most likely right away. So because if you're gonna make 200 grand, 250, even 150, it's probably worth having that corporation to cover that particular job, even if you're kind of stuck with the corporation for the next year or two with all those fees and stuff, because you would stand to lose so much from not having a corporation, because under that 2018 Tax Cuts and Jobs Act, like I said, you lose all your deductions. So if you say made 200 grand and you spent 50 grand on an agent, manager, lawyer, you're still paying taxes on 200 grand. And that hurts because and that 50 grand that you're not getting to write off is at the very tip top of your tax rates. So that's probably 30, let's see, at 200 grand, you might be you're at least in 24%, but you might even be up in 32% bracket at that point. And then you add another 9% over on California. So although California would give you the deduction, so I take that back. But you don't want to lose up to 32% of deductions at that point. But to go back and reiterate the answer to the question is, I would say probably like 70 grand is probably if where you're consistent at 70 grand, then it might be time to at least think about corporation.
Great. And what are the tax filing requirements related to the S Corp or the LLC? Is it corporate quarterly payment? Are you doing payments? What's that?
Yeah, well, you have to have with the corporation, of course, you have to have payroll. So there are quarterly filings. If you don't pay payroll in those filings, you can file a zero return. So it's not like you necessarily would have to have a payroll in every quarter. But yeah, you do have quarterly filings, but it's different than, say, like estimated taxes, because if you're running payroll, then it's making sure that you're paying because payroll is like its own little like niche in accounting, because it can be confusing in itself, because if you look at any of your paychecks, you'll see there's like 5 or 6 different things that are taken as deductions. Federal withholdings, California withholdings, Social Security, Medicare, state disability, all those things that are happening. Those are all happening behind the scenes. So whoever's paying you is not keeping that money. They're sending that off to all of those different like entities, and it's going in your bucket that has your name on it somewhere, and it's and that's what's happening with that money. So that's why payroll is its own little animal when it comes to all of this stuff.
Okay, great. And so I don't know if there's a percentage, but somebody was asking, so how much should we realistically be putting away for taxes with each paycheck if you had an LLC or an S Corp? So I don't know if they're looking for a percentage, but. Yeah,
it all depends on where you're at in terms of income. So if it's an LLC, or an S Corp, I guess, you would want to keep it. The thing that is often missed in all of it is the self-employment tax, say with an LLC, meaning the Social Security and Medicare that you pay on that. So you don't just pay federal and state. Unfortunately, you pay 15% to Social Security and Medicare. That has nothing to do with those federal and state taxes that you pay. So you at least want to save that 15%. So if you're you know, because if you got an LLC, then that means your income's coming like nobody's taking any money out of it. So
Right.
you at least want to have 15% because that would at least cover that Social Security and Medicare. Like I had somebody, just to give you an example, I had somebody who I filed just the other day who has a family of 4, made about 70 grand. Their taxes got down, their federal taxes got down to 0 because of the child tax credit and some other things. But they had $9,700 to pay in self-employment tax. So it's like that was their only tax, and it sounds crazy, but like that was, they almost had $10,000 worth in taxes to pay, even though they had 0 federal tax bill. So yeah, so it's and now with an S corp, you still would want, if you're waiting till the end of the year to run your payroll, you'd still want to save about that same amount. So the higher your income is, you want the 15% plus whatever your tax rate's going to be. So if you're making $100,000, then you may want to save, you know, if you clear $100,000, then you're going to want to save that 15% plus. You're in a 22% bracket federally. You're in a 9% bracket state. So now that doesn't mean necessarily that all of your income's being taxed at those rates because it graduates up.
Yeah.
But you probably would have, with $100,000, if you don't have any taxes taken out, you might have $35,000 to pay in taxes.
Okay.
The higher your income goes,
Yes.
yeah, it's great. Yeah, and the higher your income goes, the more you have to pay. So it's like if you make 400 grand, you're gonna pay like 160 grand in taxes. So just keep that in mind.
Great. Just a couple more questions. We're going to move on to our next subject.
All right.
If I have, you know, I have an LLC, and then because of COVID, I've been completely shut down, right? Would I be eligible for a PP loan as an independent contractor?
Yeah, they're gonna base it on your 2019 income though. So you would have to, you file for the PPP loan with your bank, and you should be eligible for something as long as you had profit, not just income, but profit from your LLC in 2019.
Perfect.
And same with a corporation. If you had payroll, then you should have some availability of PPP.
Great. And am I still able to contribute to a Roth IRA if I have an LLC?
Oh yeah, you can contribute to a Roth. You can contribute. What's great about an LLC or an S corp, if you're really trying to pack away into retirements, you can contribute to a SEP IRA and to a Roth IRA or a traditional IRA, because the SEP IRA is on the business side and the Roth is on the personal side.
Great. And all of us have the ability to contribute towards the Roth up until the 15th of this year, right?
Correct.
You can make those payments up until you file your taxes, right?
Right. Correct.
Okay, great. Okay, we're gonna shift a little bit. We had a lot of questions just about filing taxes this year during the pandemic. So we're gonna take a little pivot to focus on that. So some people just had some basic questions of, am I able to file my taxes on my own? And how should I assess if I should?
That's a good question. I mean, there are definitely ways to file taxes on your own if you want to try it. You know, there's always TurboTax, and there's other even free services out there. You can go on the IRS website and find some services that are I think all of, even Intuit and all those services, like, have to provide a free version of things, but they don't advertise it, obviously. So you can go and do that. You know, just it's always, I mean, as a tax professional, just know that you know, if everything is pretty simple, then you should be fine. But if things get complicated, you might want to seek help, even if you didn't make a ton of money, because usually you can find someone to do it. You know, it may not cost you that much for that peace of mind to know you've done it correctly.
Great. And I just want to alert everybody to the chat. We're going to start putting in a lot of resources right now, right? So some of the resources that we really know about and use all the time at the Actors Fund is there's free file through the URL, through the IRS, right? So that link is going to go up through VITA, right? The Actors Fund also navigates a VITA site through Los Angeles that you can file for free with a hotline consultation guide at myfreetaxes.com, which is a VITA site, a VITA provided platform underwritten by United Way. We also have some free links for how you file state taxes for free for California, New York, and Chicago. So those links are going to be coming into the chat right now as well. So we know that there is a limited resource right now because of the pandemic, and many entities are only doing it virtually or drop off. We are really sad to report that our VITA site will not be open this season, and we know that that is a loss, and we really apologize. We weren't able to figure out the infrastructure to do a drop-off system with our volunteer base. Also in the chat, there will be a VITA locator, a link. There are some VITA sites that are in operation, and if you've used VITA in the past, you can use that link to see if there is a site that might meet your needs, and we hope that there is. So all of those links are going to be coming up in the chat as we continue to ask Ronnie some specific questions. So we have a lot of questions about what to do if I owe back taxes. So if I owe back taxes, one of the questions is, do I need to file like chronologically? So like if I didn't file 2018 and I didn't file last year, can I still file this year? Or do I have to file in chronological order?
No, you can file any, you don't necessarily have to go. I mean, you should go and file. It's probably best to file chronologically, but if you, but it's not a problem to file out of order.
Okay, great. And somebody asked, can I file taxes if I'm married? So can you file on my own? Can you talk about just, are there any limitations to what I can't do as a person filing by myself,
Well, you can't, yes, you can't file as a single person. You have to file as married, filing separately. So if you, and that is not a tax advantaged position. So it is very rarely turns out that that's even equal to filing as married, filing jointly. And in California, it's a special problem because you technically, if you are married, then it's a community property state. So what you're technically supposed to do is take your spouse's income and your income, and you're supposed to split it down the middle. So literally you would take, if you have a W-2 for $50,000, then you put $25,000 on your return and $25,000 on your spouse's return. And then if your spouse had one for $100,000, they put $50,000. It's a very complex return. So if you're doing it right, there's really no reason to file. There's no good reason to file. I'm sorry, there are a couple of good reasons, but only if you live in different states and your state is like a non-tax, like a state, like a Nevada, Florida, Tennessee, and so you don't have to pay, a spouse. I do have a couple of people like that where we'll file as married filing separately, but it is a real pain to do.
Okay, great. And then also in the chat, I just want to call to people's attention that we do have the link if you need to paper file, right? So if you're just somebody out there that has limited capacity to technology, there is a way to paper file, go onto the IRS, print your return and send it in the mail. So that link we also have in our chat. Ronnie, help us understand, like, if we really don't feel like we feel like we're going to owe, right? We got the added $600 a week. We haven't worked in a year. We've lived off of unemployment. Like, this is just the state of grace that we're all managing right now. And we don't have the $300, right, to go to professional person. Can you just speak a little bit about filing an extension and how we would discern if it's worth it to file an extension or not? Can you speak to that, please?
Yeah, there's no advantage to filing an extension in terms of it doesn't put off your time to pay. So you might as well find out the bad news now so that you can find out how much you owe, and then you because an extension is not an extension of time to pay. An extension is only an extension of time to file. And so it's usually an extension it might be precipitated by the idea of, like if you have a K-1 that's coming that hasn't come, or you have just some stuff you can't get together. Sometimes if you've had foreign income, it might be hard to get your foreign tax return done first. So long story short, you want to go ahead and file because you want to find out. You want to find out what you owe. And then you can deal with like whatever you got to do there. So you can set up a payment plan with the IRS. You can do whatever you need to do at that point to do that. So I think you get it. I think I said too much.
No, that's great. Thank you. And can you help us understand, what do I do if I can't find my tax documents? So I think this might be like you were saying before, like, you know, my 1099 doesn't come in, my 1099-G, or maybe I'm somebody who owes back taxes and I can't find all my W-2s. Is there a process you could tell us about to locate my back tax documents?
If you owe, like if you need to file for previous years, you can get IRS transcripts for it. Those don't include California. You could just Google IRS transcripts, and and then you have to go through a process to try to, like, you have to identify yourself and all this, sign up. In California, you can go to the Franchise Tax Board site and do something similar. It's a little bit of a pain because you gotta get an account, which means you gotta like wait for a PIN number to come in the mail for like 10 days or something. But it is possible to do it, and that's just a process you have to do. You could always try to go to the payers if you know who paid you those years and try to get them to reissue you a W-2. And a nice little resource is the Screen Actors Guild website has a list of at least all of the payroll companies that pay within, you know, within the industry. So like your Disney company, or which is, I guess, Alameda, or you know, all of those, 20th Century Fox,
Great.
all that stuff. Yeah.
Okay. And just one last question on this. So if I want to file my taxes as a sole proprietor business, can I do that?
Yeah, I mean, you not only can do that, you need to do that. So you should do that. And it's just a Schedule C that's added to your tax return. It's just part of your tax return as a sole proprietor.
Okay, great. And I just wanted to call to everybody's attention in the chat. We did have some IRS tax tips around fraud, right, around unemployment, and just some other things that are happening, some other scams that are happening. There's a lot of fraud related to unemployment claims. So just heads up for that if you have a chance to view that, and just some consumer alerts. So those links went into the chat as well. Okay, we're going to pivot again, just around business deductions. So are there any specific COVID-related tax breaks that we should know about related to our industry, or any other incentives regarding deductions?
No, not related to our industry. There's nothing. No, there's nothing specifically COVID related with our industry. But one thing to note, if you don't already know it, is that if you had to pull money out of an IRA or a 401k, and you took it as a result of, you know, you just needed the money for coronavirus reasons, then that can be. Now, what I'm not 100% sure about is if you had to have applied for that when you took it out. I don't think so. But if it was a coronavirus related distribution, then you can avoid the 10% penalty that comes with having done an early withdrawal. And you can also, if it's a big enough thing and you don't want to pay all the taxes on it, because you know, if it's an IRA or if it's a traditional IRA or a 401k, it's taxable income. So it's taxable income plus the 10%. You can get rid of the 10%, and you can spread out the taxable income over 3 years. So that's kind of a cool thing. So if you had to take out, 20 grand or something, you may not want to pay all the taxes on that one year. You certainly don't want to pay that $2,000 penalty, which is also another $500 for California because they take 2.5%. Not 5. Is that right? I don't know if I did the math right there, but
Okay.
yeah.
Great. And then we have a lot of questions about, right, a lot of people still have their customary business expenses as being a performing artist that they incurred in 2020, but very little income. And so there's a question of, can I still write it off, right? So I have all these expenses, can I still write it off?
Absolutely. Yeah, absolutely. The fact that because if you think of it as you're running a business, and businesses often have years where they, especially in the early days, they take losses year over year sometimes, and and a lot of just regular. I mean, a buddy of mine who runs a restaurant, he had a huge loss last year, and I see it with a lot of my tax clients too. So yeah, no, you can do that for sure. It's a business you're running. So you can take a loss.
Perfect. And is it possible to carry acting business expenses from 2019 to 2020 to offset?
No, unfortunately not. You can't move. You're typically going to be working on what's called a cash basis, which just means that the income and expenses that happen within the calendar year are what count for that calendar year.
Perfect. And does claiming a home office space trigger an audit? What's your experience and what triggers an audit?
Well, that's a hard one because we don't really know what triggers audits. I mean, they literally have a secret formula that triggers audits. We had an IRS guy come and talk to our office a few years back, and he was a really nice guy, and he kind of told us the whole process of auditing, and it almost sounded like something from sci-fi. It was literally like, but without getting deep into that, the formula that kicks it out of in the electronic system is a formula that's been devised by some mathematicians that is a secret formula. So, and it does include randomness in it as well as other things. In a home office, we used to think that maybe a home office does. I think it's just like any other deduction to some degree. It's like it could. But if you have a legitimate setup as a home office, I wouldn't let that scare you from taking the deduction, because if you have, and that's for any deduction. Now, what you need to understand about a home office, just to quickly hit that, is that it has to be an area that's regularly and exclusively used for business. So you can't just say, well, I work in my living room on my laptop, so that's my home office. That takes up about half of my apartment, so I'm going to take half of my apartment as a deduction. It's like, no, it's that little space in the corner that you have. Now, if you have a bedroom, if you have a 2-bedroom and you use one bedroom as an office, that can be a substantial deduction. That might be 15% of your space, might even be 20% in some cases, depending on how large the bedroom is. And if you have storage space, can be, if you have like storage area, that can be considered as long as that's part of the calculation of the square footage. But yeah, you would always want to take that deduction if you have it, if it's legit. Just make sure you're taking it the right way, because I do think as a human being that knows taxes, if I was a IRS auditor and I see that it's taking up 50% of your home, then I'm going to go, yeah, let's have them prove that, because that doesn't look real, and because that gives you a massive deduction. And it's like, no, you live there. Now, I'm not saying it's not possible. I'm just saying it's not probable. So if it's the truth, then take it. But then if you get audited, then just be ready to prove it.
Perfect. Okay. And then we did have a lot of questions, and we know there were a lot of questions about this definition of what are legitimate business deductions. And we have about 15 minutes left on our time. And what I'm going to recommend is on our Actors Fund Vita website. Also, I'm going to do a little plug here for Chuck Sloan and Steadman Tax Service. They do an outstanding website breakdown of what are legitimate deductions, really, like how do you look at that cell phone, exactly this home office space that Ronnie was just talking about. So we're not going to have time today to go into the granularity of entertainment industry business deductions, and want to just usher everybody to the Chuck Sloan website, want to usher everybody to the Actors Fund website. Under our VITA financial wellness link, you would see our VITA packet, which has a very well organized list of deductions. But what I will do is just open it up to Ronnie, and just, can you tell us the things, I mean, you talked a little bit about the home office. What are the common misconceptions, right, that you see in your practice that maybe we could spend 5 or 10 minutes just on those common misconceptions?
Most of the misconceptions are things that you think you can write off that you can't, which are things like your streetwear, clothing. You might buy something for an audition and then try to write that off because you're like, well, I bought this shirt for an audition. It's like, well, that's not a deduction unless it's a costume. So you could maybe, the IRS defines it as anything that is streetwear is not deductible. But if you can make the case as a costume, so if you buy, I don't know, if you buy a golf shirt and you're not someone who wears a golf shirt, you could maybe make that case as long as you might lose it in an audit, but you could maybe make that case that, hey, this is not something I would ever wear in my life. This meets the definition of a costume for me. But the IRS would really want it to be more like a police uniform or a clown, outfit or something like that.
Right.
And then that's the same for a lot of times people want to take their makeup and hair care as a deduction. It's like, well, only if it's really specific to, like, if it's theater makeup, so that would qualify, or if it's something really like, or if you have to get your makeup done to get your headshots done, or you get your hair done for that, but your maintenance on your hair, your maintenance and your just everyday makeup, not a deduction, unfortunately. And that's
Right.
one that people often want to be one, and it's not, unfortunately.
Yeah, and there's usually a lot of questions about my gym, right, or my Peloton bike, or my
Mhm.
all these things that I use to
Yeah,
keep myself fit, right, because I need to be
right.
presentable to be in the industry. Can you speak a little bit to that?
Yeah, GEM is is explicitly in the there's what's called the MSSP. It's the market segment specialization paper that the IRS puts together. It's not specifically in the law because they can't cover everything in the law, but it's a guidelines for our industry, or for different industries, and they have one for entertainers, actors, and it's specifically and explicitly you can't take a GEM membership. Now.
Cannot, right? You
If you're taking
cannot.
it,
Sorry, Ronnie, you
you
just kind of went
cannot,
off a
right?
little bit. You cannot.
Oh, sorry. Yeah, no, you cannot take that, and you cannot take Peloton or anything gym related. You could maybe make that case if you're a stunt person, that it's essential to your health, essential to your job. That would be like, it's a gray area there because it's so specific in the MSSP that you can't do it. So that's what makes it like a almost like, nah, you just can't. Now, like if you took, say, dance classes or something because you're in a theater show, or that may not be specifically acting, but like it's part of your entertainment thing. Another thing that people think a lot of times is that you can take plastic surgery, and that is also not something you can take as a deduction.
Thank you for that clarity. Let's talk a little bit about the cell phone. I know the cell phone comes up a lot, and how much of my cell phone, or people thinking, well, I only use my cell phone to be available for auditions and available for my work. Can you share with us a little bit about how we might reframe that or look at what might be acceptable?
Yeah, you can take the percentage of your cell phone that is a deductible portion. So, in other words, I know it's always hard to say what's that exact percentage, but so it's probably more of a feeling. I don't think an IRS auditor is going to be getting down in the into your phone bill, but you want to be reasonable with that, and kind of think about it. I mean, because obviously you might be using your phone like 60, 70% for business, but you're also taking into account you're using it for personal stuff too. So you wouldn't want to take the whole thing. And that same thing would go for your home internet. And then for like your Hulu, Netflix, cable, that kind of thing, you can take a portion of that. Well, that's not specifically addressed in the MSSP necessarily, but as a research expense, because the auditors wouldn't want you to take any of it, I would say, but they'll allow some of that as a research. What it says there is that you should actually keep a log and put like exactly what was what, you know, like what you learned from it. Why did you research that thing? If you did that, you could probably count 100%, as long as you're like logging everything that you watch and saying, this is why I watched it. But if you're not doing that, I wouldn't take the whole thing, maybe take 50%, something like that.
Wonderful.
And it should hold up.
Great. And then we just had a fun question. I know it's specific, but somebody said that they use their dogs on background work, and they were wondering if they could write on it related to their dogs. That's a really fun question. I hope you're out there. That made me smile when we heard that.
That's great. You know, I've never heard that question before. But yeah, I mean, well, yes and no. I mean, you couldn't do anything that would be just like regular maintenance on the dog, but anything that would be job related. So like if you're having to, I guess you have to buy dog, you know, the bags that you have to pick things up before, like you know, if there's outfits you got to buy for the dog, something like that, I would say, then yeah, you'd have to really relate it to it being job related though. So none of them, I wouldn't think none of the medical, none of that kind of stuff. I guess in that case, the grooming, different from a human being, I guess I'd say probably I'd probably risk, you know, if I had to groom my dog, because the dog, not just regular grooming, but if you had to do a specific thing, because that's why they cast your dog, is like, because it has, you know, it's a poodle with like, you know, pigtails or something, then maybe you would, that should be okay.
Okay,
that's
and then
question.
Clarify for us, is there a standard deduction for the home-based office business? Is there a standard deduction, or safe harbor?
There is, but I rarely ever use it because it's hardly worth anything. And it's not, there is one. You still have to know what your like percentage of the home is that's business. You still have to have you know, you still have to know what those things are.
Okay.
But it's such a worthless deduction that I rarely ever take it.
Okay, great. And then can you speak a little bit about donations and charity allowance write-offs? So the question was, if I donate 300, does it reduce my taxes by 300? So maybe that organization.
Yeah, no, it doesn't. It goes on your, now 300 is an interesting number, because this year, because of COVID, they will allow you to put 300 as a as a front of the line, above the line deduction is what it's called. Now, only on cash donations though, not on money donations, I should say, not on in-kind donations. So in-kind, but otherwise, in-kind and cash donations or money donations go on the Schedule A as just a part of everything that's on the Schedule A. And unless everything on the Schedule A reaches above that standard deduction, you're not going to get anything for your charity, unfortunately.
Okay, thank you so much. And I just want to let people know that in the chat there's the business deduction expenses from VITA. We have that posted now. And then we also have the website up for Chuck Sloan as well. One of our other questions, just to pivot a little bit, was about health insurance. And the question was, is the IRS penalty in California strictly for whether you had insurance or not?
Yes, it's not an IRS penalty anymore. It's actually the Franchise Tax Board of California that administers that penalty. So the IRS no longer administers it, but it is essentially identical to the one that the IRS was administering 2 years ago. So if you don't have it, then you will pay. I'm trying to remember. I think the minimum number is like $750. I think. I can't remember exactly, or you will pay a percentage of your income. So if you make a lot of income, it could be a pretty big. Now, if you make like hardly any income, oh, I see somebody confirmed the 750. If you make hardly any income, then you actually won't get that penalty. But you should probably, if you're below I think it's 16,000, then you should go and get Medi-Cal, so at least you're covered and it won't cost you anything. So that would be, and then the Covered California thing, if you're not making a lot of income, can be a good thing. What kind of hurts is when you're in a sort of middle ground where you're having to pay all this money for insurance, but you're maybe making like $40,000, and in California that doesn't, in New York I'm sure doesn't go very far, and then you're having to pay $700 in insurance a month or whatever that might be. That's where it can be really, really tough. So you just maybe have to do the math and go, if you don't want to have insurance, then you just suck it up and take the penalty, I guess, in that scenario. Because it's going to be cheaper than having the insurance. But I'm not telling anyone not to have insurance. I'm just saying if that's your choice, then it is cheaper than having insurance, most likely.
Great, thank you so much. And I did just also want to make sure everybody on our webinar today understands that the Actors Fund has a health insurance resource center in relationship with Motion Picture Television Fund. So if you don't have insurance, you're concerned about insurance, there's a free resource there. We have online webinars and workshops, as well as a hotline to call to get information and really make sure that you're covered with health insurance. So we are about at our time. We're going to say goodbye to Ronnie. Thank you so much for sharing all of your information with us. And we're going to go to our slide. And if everybody does have a moment, there's some links on there. There's also our survey. If you could please fill out a survey and let us know how we did. If we answered your questions, that would be really helpful for us to receive your feedback. We will stay on a couple minutes after, just to make sure that people have the links cut and pasted and that they're okay. And please reach out and let us know if the Actors Fund can help you. Okay. All right, everybody. Thank you so much for joining us today. We hope that you are safe and well. We hope you engage in our financial wellness program. Come check out Samara and do those groups for us. If you need any additional information, we do have our LA groups at actorsfund.org. Please feel free to email us there, and we'll do our best to share our links and our resources with you. And we hope to see you really soon at the Actors Fund. Take care.